Hello everyone! If you glanced away for even a moment over the past several days, you may have completely missed one of the clearest, loudest signals the metals market has sent in years. A seasoned commodities veteran quietly began unloading a massive portion of his physical silver holdings while the broader crowd continued chanting, "To the moon." Yes, at a moment when silver has taken on almost religious significance for some investors, he sold close to 80% of his physical stack. Not because he suddenly turned bearish, not because the long-term silver thesis collapsed. He sold because the trade itself evolved, and then, instead of walking away, he redirected a significant portion of that capital into an area most retail investors barely pay attention to until prices have already doubled: mining equities. Before we go any further, a quick 10-second note. I'm actively running a campaign to push back against copycat channels that recycle other people's work and drown out original research. If you want this space cleaned up, support the effort by subscribing right now and comment John AG so I know you're part of the campaign. All right, here's why this matters. When a deeply experienced speculator sells into euphoria, it forces an uncomfortable question. Are you investing or are you emotionally attached? Those two things are not the same. And heading into 2026, that difference may determine who compounds wealth and who becomes exit liquidity. Let's set the stage properly. Silver has been on an absolute tear. The narratives are everywhere: currency debasement, tight physical supply, industrial demand, solar expansion, electrification, geopolitical tension, political instability, and more. Here's the dangerous part. Most of those stories were also true when silver was cheap. Nobody cared then. People care now because price action validated the narrative in their minds. That's exactly how bubbles form, not because the thesis is false, but because the crowd discovers the thesis late and mistakes momentum for certainty. So when someone who's navigated these markets for decades says, "I trimmed aggressively," it's not automatically a forecast of collapse. It's a reminder of discipline. He treated physical silver as a speculative allocation, not a sacred relic. And when the conditions that justified the position shifted, he adjusted. That's the core idea you need to understand, and I'll say it plainly. You don't need to call the top to make a smart decision. You only need to recognize when the risk-reward balance changes and when another expression of the same theme offers a better payoff. Think about it this way. Owning physical silver is owning the commodity itself. You need the metal price to continue rising to keep benefiting. Owning quality silver miners, on the other hand, is like owning a leveraged operating business. If prices merely remain elevated, profitability can explode. And when profitability surges, valuations often follow. That's the entire rotation logic in one breath. But don't take that at face value. Let's break it down. When analysts model mining companies, they rarely plug current peak prices into their spreadsheets. After a strong run, they tend to use conservative assumptions. That means many mining equities are still valued as if silver prices are far lower than today's spot market. In other words, the stock market may be living in a completely different silver reality than the physical market. If silver holds anywhere near current levels, miners can deliver earning surprises without needing another parabolic move in the metal. And earning surprises are powerful because markets hate being wrong. Now add a layer most people miss. Mining profitability isn't linear. Small moves in the metal price can cause massive changes in margins because costs don't rise the same way revenues do. Here's a simple illustration. If a producer's all-in cost is $25 per ounce and silver sells for $50, the margin is $25. If silver rises to $75, the margin jumps to $50. The price increased by 50%, but margins doubled. When margins double, free cash flow can go wild, especially for companies not buried under debt. That's why miners can outperform even if silver doesn't repeat last year's performance. But here's where smart money separates itself from hype. Not every company labeled silver is actually a silver company. Some have the word on the ticker and almost no silver in the ground. Others own marginal projects that remain uneconomic even at high prices unless they dilute shareholders endlessly. And some are essentially marketing vehicles designed to sell hope, not ounces. So when you hear miners will outperform, understand that it means a select group of quality producers, royalty and streaming businesses, and credible developers may outperform, while the junk gets exposed. Let me drop a cliffhanger here. If you stay with me, I'll break down the exact trap retail investors fall into when chasing junior silver stocks, and why that trap is likely to snap shut on a lot of people in 2026. But first, a quick reminder. Check the description for bonus links, including the premium WhatsApp channel and the option to join the channel membership. If you want deeper research and faster updates, that's where you'll find it. Now back to psychology, because this is the heart of the discussion. When markets run hard, people begin defending assets as if they're part of their identity. Say correction, and they hear attack. Say risk management, and they accuse you of trading. That's not investing. That's tribalism. And when an asset becomes tribal, corrections tend to be violent. Not because the thesis fails, but because weak hands bought for the wrong reasons. History is ruthless here. Precious metals don't move in straight lines. They surge, collapse, rebuild, and surge again. Even in powerful bull markets, brutal drawdowns shake out emotional participants. That's why I respect disciplined trimming, not because fear is useful, but because survival matters. I want you still in the game 10 years from now. So let's talk about the move that shocked people, selling physical silver and rotating into miners. What's the real logic? First, physical silver can be insurance or speculation. If you're stacking because you believe you may need it during a monetary crisis, that's one framework. If you're stacking because you expect a triple in a year, that's another. Mixing those frameworks is how people get hurt. Second, miners are valued using models, and models lag reality. Physical silver moves fast. Equity analysts update slowly. That creates a window where miners still discount old prices while the metal trades at new ones. When that gap closes, it can close violently. Third, miners have multiple paths to winning. Flat silver, lower costs, new mines, better grades, byproduct credits, improved recoveries, refinancing, buybacks, dividends, mergers. Physical silver has one path, price up. Does that mean physical silver is useless? Absolutely not. As part of an insurance allocation, holding a core position makes sense for many people. But if you're running a speculative book, your job isn't to worship metal. Your job is to allocate to the best payoff. That's where miners enter the picture. Now let's zoom in on why miners remain underloved. 1. The sector carries trauma. Investors remember dilution, reckless management, blown budgets, permitting nightmares, tax changes, political upheaval, floods, energy spikes, you name it. That memory keeps capital away. 2. The broader market spent years obsessed with tech narratives, starving real assets of attention. Even when metals performed, miners lagged because they weren't cool. 3. Passive flows distort pricing. ETFs buy liquidity, not value, leaving quality names overlooked. So yes, the setup can be real. But here's the trap. Junior mania convinces people every explorer is a lottery ticket. They ignore the two things that matter more than drill results: capital structure and timeline. A junior can own a world-class deposit and still destroy shareholders through endless dilution. It can also sit idle for years as permitting, financing, and politics crawl forward. That's why professionals focus on probability over possibility. A high probability triple beats a low probability 10-bagger that never happens. Ask yourself, are you buying probability or paying for a dream? And since I want to hear from you, drop a comment. What's your core metals position and what's your speculative position? Now let's add another dimension many scripts ignore. Industrial demand isn't a slogan, it's structural. Silver isn't just money. It's an industrial input used in electronics, solar panels, medical devices, and technologies tied to electrification. In many applications, silver demand is price inelastic in the short term. If silver represents a tiny fraction of total product cost, higher prices don't immediately reduce usage. That's why silver can behave differently than gold during certain cycles. Let's anchor this with numbers. Global mine supply typically runs around 800-900 million ounces per year, with recycling adding a couple hundred million more. But recycling doesn't respond instantly. Scrap doesn't flood the market overnight. Meanwhile, industrial demand steadily absorbs supply through electronics, grids, EVs, and solar, where small amounts per unit compound at scale. Now here's the nuance the shortage forever crowd avoids. Tight markets don't go straight up. Tight means sensitive. Small changes in marginal buying can send prices soaring or collapsing. That's why discipline matters. Conviction means having a plan. Stubbornness means refusing to adapt when conditions shift. Another powerful tool is the gold to silver ratio. Over history, it swings like a pendulum. High ratios often signal silver undervaluation. Low ratios suggest silver is relatively expensive. It doesn't predict tomorrow, but it contextualizes where you are in the cycle. After a major catch-up run, much of the easy upside may be gone. That doesn't mean silver can't rise, but the next phase tends to be choppier and more selective. That's where miners matter more than memes. Many producers are still valued as if they're selling silver at much lower internal prices than today's spot market. That gap can close quickly, but not evenly. Operators who convert high prices into real free cash flow will be rewarded. Those who look good on social media but bad on income statements will be punished. Here's a practical lens. If silver stays elevated, strong miners should be able to do at least one of three things: reduce debt, return capital via dividends or buybacks, or fund growth internally without dilution. These are measurable outcomes you can track quarter by quarter. Now a counterpoint that can save you real money. Miners are cheap doesn't mean miners must rise. Sometimes cheap reflects real risk: jurisdictional uncertainty, cost inflation, weak reserves, bad acquisitions, poor management. Cheap can stay cheap. Cheap can get cheaper. Cheap can go to zero. Remember this: In the next correction, survivors will be defined by liquidity. Cash, credit lines, low debt, flexible cost structures. Liquidity is oxygen. When it disappears, stories don't matter. So here's a question. If silver dropped 25% next month, would you buy or panic? Be honest. Your answer tells you if you belong in this sector or just pass through for the hype. Let's challenge another claim. Silver shortages don't guarantee infinite price appreciation. Higher prices incentivize recycling, substitution, and new supply over time. Demand can also soften during economic slowdowns. The smarter framing is that silver may remain structurally tight, but volatile. Tight markets amplify drawdowns. They don't eliminate them. Now gold. The same veteran didn't abandon gold. He framed it as insurance rather than speculation. That makes sense. Gold is the monetary metal central banks respect. It tends to shine when real yields go negative and confidence in paper erodes. But gold can still fall 30% within a bull market. If you can't emotionally handle that, you'll sell at the worst time. What would invalidate the gold thesis? 3 things. Real fiscal discipline, addressing off-balance sheet liabilities, and sustained positive real yields. And real yields are controversial because inflation is lived, not theoretical. Groceries, housing, insurance, healthcare, energy. These define reality. If real yields stay negative, gold retains relevance. Policy regimes rotate. Timing shifts. In the early 1980s, high real yields crushed gold. Later, debt expansion restored its footing. Expect regime change. Don't assume permanence. Now, streaming and royalty companies. They're a hybrid between miners and metals. They offer upside exposure with less operational risk, but valuation, deal flow, and management discipline still matter. Copper is becoming a quiet driver here. Many silver streams are tied to copper mines. As copper projects ramp, silver streams benefit. That linkage may matter more than people realize going forward. Briefly on uranium. It's not a meme. It's structural. Long-term contracts matter more than spot quotes. Inventory locked in vehicles isn't real supply. If you're in uranium equities, ask whether the company has material and a realistic path to cash flow. Noise is everywhere. Bringing it back to silver. The question isn't, is silver bullish? It's, what's the best risk-adjusted expression of the silver theme right now? Physical for some, producers for others, royalties or selective developers for the rest. But buying anything with silver in the name isn't investing, it's gambling. Here's another cliffhanger. The most dangerous phase of a metals bull market isn't the crash, it's the euphoric middle, when management teams get addicted to issuing shares and retail gets diluted while believing they're winning. Before we continue, check the description for another channel focused on real silver success stories. Study results, not rhetoric, now dilution. In bull markets, capital flows easily. Companies raise money at higher prices. That can turn toxic. Share counts balloon, costs creep, and when markets turn, those relying on constant financing implode. Treat share structure like oxygen. Producers can self-fund. Explorers often live on dilution. Energy matters too. Mining costs are tied to diesel, power, transport. Rising energy prices compress margins. Oil has its own underinvestment story. Years of underinvestment erode supply capacity. Demand doesn't disappear politely. Price spikes follow. Oil can be both tailwind and headwind, benefiting energy equities while pressuring miners. Let's pause and make this personal. If you're doing well, share your success in the comments. Progress is contagious. And remember the bonus links, including the premium WhatsApp channel and membership, where a separate research team goes deeper. Now, what could go wrong with the miners outperform thesis? Cost inflation, political risk, operational risk, valuation risk, selection matters. Here's a practical checklist. Do they produce today? What's their cost structure, debt profile, hedging, share count trend, jurisdiction risk, asset diversification, management behavior? Ask those questions and you're ahead of most investors. And now, the most dangerous phase, the middle. High prices, euphoria, endless opportunity, rampant junk, diluted discipline. Sideways markets expose tourists faster than crashes. If silver moves sideways for a year, you'll discover who you really are. Tie it all together. Selling physical silver to rotate into miners wasn't a call that silver is dead. It was a preference for a better payoff profile at this stage, bullish without being reckless. Equity lags often last longer than expected. Metals move first. Equities follow, then they overshoot. If 2025 was the year of the metal, 2026 could be the year of quality miners if prices hold above economic thresholds tied to replacement cost. Mines are slower to build than narratives. That's why tightness persists. Expect volatility, expect corrections, expect opportunity, build a plan, separate insurance from speculation, keep cash, avoid worship, learn to be early, not late. To wrap up, know why you hold physical silver, select miners carefully, respect valuation and royalties, understand gold's role, filter uranium noise, watch energy dynamics, control emotions. If you got value, subscribe, check the bonus links, join if you want deeper research, and if you're winning, share your story. It might help someone else take the next step. One last thing, and it matters. Everything here is educational only. These are personal opinions and general market commentary, not individualized financial advice. Do your own research, assess your risk tolerance, and consult a qualified professional if needed before making investment decisions.